Today we're going to be talking about cash flow versus appreciation and which one is right for you. Hi everyone, I'm Dr. Avishkar Sabharwal, the Immigrant Doctor, and welcome to my podcast. So, I was visiting California last week and I happened to stumble upon two other investors who invest in real estate. And we started talking, which is what sparked the idea for this episode. One of them completely changed the way I think about other investors. When I had started investing, through all the trainings that I've had, all the learnings that I've had, my ideology was invest in cash flow first and then look for appreciation. So when I was talking to this gentleman, he said, I only invest in the Bay Area and I only invest for appreciation. And this was a very pivotal moment because all this while I had been learning that appreciation is good, but you cannot bet on it. Of course, I did not know his backstory, which changed the whole perspective on what he was saying and, gave me a deep sense of appreciation for where he was coming from. And actually, when we were talking, interesting, there was another gentleman who came in and we started talking. He, of course, invests out of state. He invests in Alabama and sort of in a similar way to the way I do it. He actually pointed out that not every investor will have the same goals on investment as you will. And you have to understand that everybody has their own point of view. This is what developed this deep sense of respect for this gentleman who has been investing in the Bay Area only for appreciation. Now, let me tell you about his story. This gentleman has been investing in the Bay Area for the last 20 years, right? So 20 years of investing in the Bay Area would have given him massive appreciation. And that's why he was betting only on appreciation, because in his 20 years of investment, he's seen so much growth of his capital by investing in these properties in the Bay Area that he thinks that's probably the right way to invest for him, right? There's nothing wrong with that ideology, but I think there are certain downsides, in my opinion, to investing just for appreciation. Number one, that the capital is just stuck in your asset, right? Even if you've invested for appreciation, say I buy a house for $100,000, suddenly it's $200,000. Doesn't matter if I don't sell it, right? It does not give me money to put somewhere else if I'm investing just for appreciation. Number two, when you're investing just for appreciation, and especially in smaller assets like small multifamily or single family, the valuation of the asset is based upon the area that you're investing in. Say for whatever reason the property prices go down in the area, the valuation of your property suddenly goes down. So the appreciation is not necessarily in your hands, right? So that's one of the reasons I put in my investments appreciation as below the cash flow. I look for cash flow first because I want to make sure that when I'm getting a debt on a property, I'm going to be net positive. I'm going to be able to meet all the expense obligations for that property before anything else, before it hits my bank, so that I'm not putting in extra money after acquiring the property to sustain it. So that's a cash flow positive asset. Now, the beauty, I've been investing in small multifamily so far, but now I'm transitioning to large multifamily. And here's the reason why. The beauty of large multifamily is that I can get both cash flow, I can get the appreciation, and I can get massive tax benefits from investing in large multifamily as well. So here's what happens. When I invest in large multifamily, of course, I'm looking for cash flow first, which basically means that all the expense obligations for my asset are met. And after that, I have a net positive cash coming into my bank account, right? That's number one. Number two is appreciation. Now, interestingly, the beauty of large multifamily is that the appreciation is based on the valuation of the asset. And how is the asset valued in large multifamily? It's valued like a business. It is valued on the income that it generates. Now, if by whatever means that I have, either by lowering the expenses, increasing the income, I can increase the revenue that this asset, net revenue that this asset is generating, I increase this valuation. So now all of a sudden, instead of having this being controlled by the market, it is somewhat in my control. I will not say 100% because, of course, even within that, the macroeconomic changes can occur and that can change the valuation of the asset. But for the most part, I'm able to force this appreciation into this asset, control the valuation and control the appreciation and see massive appreciation that I want to see in my assets, right? And number three, I get massive tax benefits because the US offers amazing tax benefits for the real estate that you invest in. And this is very different from how you invest for appreciation, right? If I were to invest for appreciation, the challenge is that's not money that's readily available to me. That's money that's locked away in the asset unless I'm able to tap into that money. So, this ties into this very interesting conversation that was continuing with this other gentleman who invests in Alabama. And he said, well, it's easy. You can always take a cash out refinance. You can do a HELOC on that property. You can do so many things. You can sell the property. So my point of view on that is, number one, if I do a cash out refi, I don't know what the bank loan terms are going to be when I need that money, right? It may be sort of like a situation like we're in now. The interest rates are super high and the terms may not be favorable for me because I might become sort of, negative. I might have to actually put money to pay the mortgage into the asset because I'm cash flow negative. Again, my goal is cash flow positive, not cash flow negative. So that's why you need to know when is the right time to take it out. Number two, even if you're doing a cash out refi or you're selling the property, it takes a while to do that. Even getting a loan on a property, you cannot just go in and get it tomorrow. If I needed money now, I would rather have it, invested in gold, because even though it's a store of value, I can go and exchange it for real dollars that I can use today or tomorrow. Whereas in real estate, the asset is still stuck there. The money is stuck in that asset till I tap it out, right? So if I need money immediately, I don't have access to it, which is very different from cash flow, wherein I'm getting in mailbox money, paycheck coming in every month, and I have that money readily available for me to use. Now, of course, most of the money is made in appreciation, right? Even in the assets, the larger assets that we plan to buy, most of the money comes in towards the end when there's a major capital event, when there's a sale or there's a cash out refi. But these are all planned events that we plan for, right? And so I can kind of control both of these levers with the information that I have, and that's why I like to invest in assets that can cash flow, that can appreciate and give me tax benefits. Having said that, all of these are moot points. And here's why I say this. All of this does not matter. What matters is what sort of investment will give you a good night's sleep. Whether it's for appreciation, whether it's for cash flow, whether it's for all of them, it really doesn't matter. You, at the end of the day, are investing so that you can have a good night's sleep. You know that your money is well invested and your money is growing, whether it's through appreciation, whether it's through cash flow, whether it's through tax benefits, whether it's through whatever, whether it's in stocks, whether it's in real estate. That, at the end of the day, is the goal of our investments, is so that we know that our future is sort of, taken care of by the investments that we are making. And that's why there's no one right way to invest. There are so many ways to invest, and what is right for you, you got to decide. For me, I decide cash flow first, appreciation next, and of course, the tax benefits that come with real estate. And but this does give me some perspective into how other people think who are primarily looking for appreciation because of their experiences with investments. Somebody invested 20 years ago and they've seen massive appreciation. Of course, that colors their perception, that changes the way they think about it. Somebody who invested around 2007, 2006 and saw a massive downturn, their perspective will be very different from somebody who has been invested and been in the game long enough. So that's what I would say. I think it all depends on what you want out of your investment and what keeps you comfortable and gives you a good night's sleep. And so at the end of the day, you got to decide what is right for you. Well, I hope you enjoyed this episode. Thank you so much for tuning in, and I'll see you all next time.